Welcome back. Previously, we were discussing about some of the techniques used for decision making with regard to investment in various projects. Let us continue with the same area. Next method, certainty equivalent method. Actually, this is a method that is introduced as a way to solve the demerit of the previous method which we have learned. Previously, we learned a method where risk adjusted discount rate is used. In that method, we were using a present value factor along with a risk factor rate, and we have been dealing with that problem area that twice. So one of the demerit of risk adjusted method was that in that method we are considering the risk factor on the base of present value concept, in which we are adjusting the risk factor in the discount rate or present value rate. But actually, always risk is associated with cash flows, not with the discount rates or the return on investment. Return on investment is just a rate, and the risk is suffered not on the rate but on the actual cash flows. In risk adjusted discount rate method, the risk factor is adjusted in the interest rate or the return rate, not on the cash flows. That is a demerit. So in order to solve that issue, certainty equivalent method was introduced. As previously we have mentioned, the discount rate cannot be considered as a best rate because cash flow is always subjected to risk, not the present value factor or the discount rate. So in order to solve that issue, certainty equivalent method was developed. So under this method, the risk involved in the project is taken into consideration by adjusting the expected cash flows and not the discount rate. First of all, the cash flows are conservatively estimated under the assumption of normal risk for various years during the life of the project. Then these risk-free cash flows are reduced to a certain level by using the correlation factor, or otherwise known as correction factor or risk adjustment factor. The concept is that you will be given an investment plan where initial investment will be there and subsequent cash inflows will be there. So in this method, you will be given cash flows. You need to adjust the certainty equivalent factor with those cash flows. The concept is that, for example, if I am getting a cash inflow of rupees 1 lakh each year for an investment, that 1 lakh is the actual risk-free inflows. We can't say that cash flows are risk-free. They will be subjected to some form of risk. So out of 1 lakh, how much amount I can certainly get? Just assume 1 lakh is the return on an investment. After adjusting all uncertainty issues, risk issues, I am sure that 70% of inflows will be received whatever the situation may be. So out of 1 lakh, my returns will be 70,000. That is the concept of certainty equivalent method. How much is the certain cash which you are going to receive or earn? That is known as certainty equivalent method. For that, you will be given a factor. Factor means there is a scale. It begins from 0 to 1. Usually you will be facing a set of 0.2, 0.3 until 1. So it begins from 0 to 1. So each cash flows will be subjected to a certainty equivalent factor. So if you adjust that certainty equality factor with the inflows, you will get the actual cash which you are going to earn. Otherwise known as certain cash. Certain means sure cash. That is known as certainty equivalent method. You will get a clear picture when we are going to discuss the same case. The equation for finding the certainty equivalent method is certainty equivalent, otherwise used as CE, risk-free cash flow divided by risky cash flow. In the question, you will be given a risk-free cash flows as well as risky cash flow. From that, you need to find the certainty equivalent factor. And the thing is that in almost all the cases, the certainty equivalent factor will be directly given in the question. But still, remember this equation, sometimes they may not give the factors. You need to identify that. In that case, in the question, the risk-free cash flows and risky cash flows will be specifically given. Risk-free cash flows is always less than the risky cash flow, so the coefficient of certainty equivalent will be less than 1. Usually the scale will be 0 to 1. So you will be given certainty equivalent factors ranging from 0 to 1. So let us discuss some of the merits of certainty equivalent method. It is simple and easy to apply. It's very easy. In the question you will be given certain cash inflows. You need to multiply the certainty equivalent factor with the cash inflows, and you can directly identify the value. Usually you will be following NPV or IRR method to take the decision making. For computing the NPV method, you need to identify present value of cash flows. For that, you need to multiply the certainty equivalent factor with the cash inflows. Then you will get a certain cash flows. From that, you need to multiply the present value factor. You will get a clear picture when we are going to deal with the practical case. Reduces uncertain cash flows to make them more realistic. As I have mentioned earlier, in this method a certainty equivalent factor is used. It is actually a factor which is used to identify the certain cash flow that we are going to earn. For example, the cash inflow from an investment is 1 lakh and the cash certainty equivalent factor is given 0.7. That means 70,000 rupees are certain, means which we are going to earn for sure. That is a concept. Considers risk by adjusting risky cash flows, because in the beginning I have mentioned that this method was introduced as a measure to overcome the issues with regard to risk adjust method. In the risk adjust method, the discount factor or the present value factor or the interest rate was adjusted, but actually the risk is always inherent in cash flows. So you need to adjust the cash flows rather than the return on investment. So in this method, it considers risk by adjusting risky cash flows. Superior to risk adjusted discount rate, as we have mentioned now. Apart from that, it also suffers from some of the demerits. Main demerits are: first one, difficult to calculate, understand. Sometimes some may find it difficult to calculate and understand, because in the question you will be given cash flows. From that cash flows you need to multiply it with certainty equivalent factor. Then you will get a certain cash flows. That certain cash flows has to be multiplied with a discount factor. Then you will get a present value factor. Sometimes some may find it difficult to calculate and understand, because there is some more steps with multiplication of various factors. Does not directly use probability distribution of possible cash flows. Here only certainty factor is considered. It doesn't give a glimpse regarding whether the organization is probable to earn that cash. The chance of probability is not measured in that. It is said that we have been discussing about an example of 1 lakh. Out of 1 lakh, 70,000 is certain, but it doesn't mean that the organization has a probability of earning that 70,000 at all time. That is an issue. This method is arbitrary and subjective, because here decision making is done by the managers and persons, so it is subjected to bias. And finally, difficult to implement in actual practice. Theoretically it is very easy to set, but in the actual decision making aspect, the organization or the top level management may find it difficult to implement practically. So let us go to the next part, decision rule. Here certainty equivalent factor or the certainty coefficient always lie between 0 to 1. As I have mentioned earlier, you will be getting a factor ranging from 0, 0.1, 0.2, 0.3, likewise until 1. Higher the risk means lower is the coefficient. Yes, if the coefficient is lower, it means your chances of getting and your earning that much amount will be less. So higher the risk means lower is the coefficient. If the coefficient factor is high, that means you are likely to earn more amount. If the coefficient factor is less, that means you are likely to earn less amount. Less amount means it is more risky. More amount means it is less risky. That is the concept. So after converting the uncertain cash flows to ascertain the cash flow by certainty coefficient, these are multiplied with the discount factor. Discount factor means because we are taking decision either on the basis of NPV method or IRR method. For NPV, you have to use present value factor or a discount factor. That's it mentioned here. Now you get present values. Then the NPV is found. Project with the highest NPV may be selected. We have done that part previously, so we are not going further into that. Uncertain cash flows into certainty coefficient into discount factor. That is how you are going to get present value. We will discuss that part in detail during the problem area. So these are the theoretical aspect with regard to certainty equivalent method, and sometimes in some situation you may ask to give a theoretical explanation regarding the steps for computation of certainty equivalent method. Don't worry, we are going to discuss that right in practical problem. Sometimes we may come across such a question also. Next case, there are two projects A and B. Each involves an investment of 1 lakh. The expected cash inflows are and the uncertain coefficient are as follows. So two projects is given, project A and project B. See, for 3 years cash flows of project A and B along with its coefficient is given. Coefficient means certainty equivalent factor. For example, here in the first year the project A will earn 60,000. Its coefficient factor is 0.8. 0.8 means simple meaning means 80%. Out of 60,000 the concern is subjected to earn 80% of amount. That is the meaning. So details of project A is given, project B is given. You are subjected to take a decision regarding whether which project has to be selected. Risk-free cutoff rate is 10%. Sometimes it may not be given in the question. In the absence of such an information, it is assumed that default rate will be 10%. State which project is better. In the question there is no specification regarding which method has to be followed, so naturally you have to go with the NPV method. I hope you know how to find an answer using the NPV method. First of all, let us deal with project A. Year and cash inflows is given in the question. Let us write down these details directly. So 3 years, cash inflow for the first year 60,000, second year 50,000, third year 50,000. Certainty equivalent coefficient is given directly in the question. So for time being we are using CE. In the exam, try to expand these abbreviations. For write down we will be using the abbreviations, but in the examination try to expand it. CE is given 0.8, 0.7, 0.9. These details are directly given in the question. The next is, out of 60,000 you need to identify the certain cash inflow. How much is the cash inflow that are sure to earn? It's very easy, just multiply these two columns. 60,000 into 0.8 you will get 48,000. 50,000 into 0.7 you will get 35,000, and 50,000 into 0.9 you will get 45,000. So these are the certain cash inflows. For time being I am using the abbreviation CCI. There is no such abbreviations are there. Try to expand it in the examinations. CCI means certain cash inflow. Certain means sure cash inflows. So out of 60,000 the company will earn a sure amount of 48,000. So next we are using the NPV method, so you need to find present value of cash inflows. Next is, in the question 10% cutoff rate is given, so discount factor let it be 10%. I hope you know how to find the discount factor 10% values. Here it is 0.909, 0.826, 0.751. Previously we had discussed the equation for finding the discount factor. Sometimes it may be given in the question. In that case it is very easy. Sometimes it may not be given in the question. In that time you need to find out these values using equations. If you are able to carry or keep logarithm table in the examinations, in that case you can easily find the discount factor of each rate by referring to the table present value of rupees 1. So just go through that. If you have any queries, please let me know. So you have got discount factors. Next you need to find present value factor. Remember, present value factor is discount factor into certain cash inflows. Never go for this cash inflows, because we have already dealt I adjusting the certainty equivalent factor, and now this is the cash inflows. From this amount only you need to find present value factor. So 48,000 into 0.909, you will get 43,632. Likewise 35,000 into 0.826, you will get this one, and 45,000 into 0.751, you will get this one. So by adding these three, you will get an amount of 1,03,337. So how we are going to take the NPV? It's very easy. This is the total present value of cash inflow. From that you need to reduce initial cash outflow or initial investment. Here it is said that involves an investment of 1 lakh. So less cost is 1 lakh. You will get an amount of 6,337. Whether this project has to be selected, we are yet to decide, because we need to find the NPV of project B also. You need to follow all these steps for project B also. So let us deal with that. Here project B cash inflows is given 50,000, 70,000 and 50,000. Certainty equivalent factor also given 0.9, 0.8, 0.7. So just next we need to find certain cash inflows. Just multiply 50,000 into 0.9, this one you will get 70,000 into 0.8, 56,000. 50,000 into points, you will get 35,000. Next you need to find the discount factor. Since there is no specification regarding separate rates for each project, it is assumed that the 10%, here in the question it is said that risk-free cutoff rate is 10%. So 10% is applicable to project A as well as project B. Sometimes in the question, very carefully you have to deal with such case. Sometimes in the question they may give separate interest rate for separate projects. So you have to deal with such cases very wisely. Since the rate is same, see, discount factor is also same in both cases. Next you need to find present value factor of each certain cash inflows of project B. Multiply these two, you will get present value factors of all these three amounts. Just add together, you will get a total amount. From that you need to reduce cost 1 lakh. You will get a difference of 13,446. So automatically from these two amounts you can see that which project is best. Definitely project B is the best, because it is having the highest NPV. So this is how you have to deal with a question or a case with regard to certainty equivalent factor. Sometimes you may ask to explain in brief the steps required for identifying a decision regarding an investment if you are using a certainty equivalent along with NPV method. Sometimes theoretical explanation may be asked. In that case you need to explain all these details very briefly. So just go through it. We will discuss about the further cases in the next sessions.